Hey, today I wanted to just put together a real quick video on a topic I think is something that can be helpful for you because a lot of people are affected by it. And what we're going to talk about today are what we call target date funds. All right, now there's a lot of different, options when it comes to this, but I'm referring to really today the topic of this conversation, the mutual funds that are available in your 401k that are target date funds. Okay, now you're going to recognize these funds because they've got numbers like 2020, which is already past this, 2030, 2040, even 2050. Okay, and some of the companies offer funds that have even in the 5-year increments, 2025, 2035, etc. So I think target date funds are actually one of those investments that they're simple, but the context around them and some of the benefits, or I should even say some of the risks associated with them might be overlooked. So let's take a quick second and go over, what exactly is a target date fund. It's what we call an age-based portfolio, and what investors do is, they take your age. Today, I'm 45 years old, so let's say, I plan on working 20 more years. That puts me at roughly 2041 to be exact. So what an investor would do is they'd sort of look at the closest fund option to their target retirement date, and they would select that one. Okay. Now, when we look under the hood of that mutual fund, for example, sometimes they do come in ETFs, but we'll talk about that at another time. When we look under the hood of those mutual funds, you're going to see a balance of stocks, which we use for growth, right? And income, fixed income, all right, which we use for income, all right? A little tough to read there, but you get the point. So if I'm retiring in 20 years, for example, I might have 80% of the portfolio in stocks and 20% of the portfolio in bonds. Now this is underneath the hood of the target date fund, okay? Now, as I get closer to that retirement date, that 80% that we have, that the manager has allocated to stocks, gets reduced, okay? So what happens on the other side? The allocation, this 20% allocation, gets increased. Now this is kind of along that simplicity theory we were talking about. This makes sense, right? Reducing your exposure to stocks, which is going to reduce some of the market volatility that your portfolio sees. That makes sense. Increasing your assets or your allocation to fixed income makes some sense, right? Because you're not getting a paycheck, so having more stability in your portfolio. But what I want to do is I want to go over some of the unforeseen risks to that, okay? Now, first of all, a lot can change in 10 or 20 years, right? I could win the lottery. You get an inheritance. You could decide that you're going to work longer. I mean, a variety of different things. So who says this date? The industry kind of puts 65 because of the Social Security and Medicare benefits that sort of trigger around that time. But for a lot of people, it could be sooner or later. So that's kind of one of the things that doesn't align necessarily with our objectives. The other thing is current conditions, right? So if we think about where we are now, it's 2021. We've got a certain economic landscape that the market is reacting to. And, as we see it now, that might make sense of having this percentage in stocks and this percentage in bonds, right? Who knows in 20 years what that's going to be? But this is just basing it based on your age and saying that based on your age determines how much should be in stocks or bonds. That doesn't make any sense. Quite frankly, if interest rates go to zero, I want to have, that would mean bonds go up, but that would change your allocation. Let me give you a better example, which is kind of the more likely scenario, the one that we're in, okay? And this is what I call the big elephant in the room. And it's interest rates, okay? Now, we talk about interest rates. You've got interest rates for your credit card, your mortgage, all these types of things. What we're talking about is typically the 10 or 30-year government bond, because a lot of different things are based off that rate. But if we look at that right now, and let's just loosely say that that rate on the 10-year is 1.7%. Okay, I think it was pretty close to that today. Actually, I think it was 1.75. Okay, now what's the first thing that we learn in our economics class about interest rates? And that is, when interest rates go up, bond prices, and I'll just put this here, interest rates, when they go up, what happens to bond prices? We know they go down, all right? Now, in the 70s, when interest rates were at 15, double digits, 17%, that made mortgages expensive, but boy, on your guaranteed government bonds that were issued, they were also paying double-digit rates. So, it was a positive in one scenario and maybe didn't work against you in another scenario. But here we are at 1.75. Now you might say, is that low or high? That's pretty much as a historic low, okay? So if we're at a historic low, we can continue going down and we can go to zero, and you can actually have negative interest rates. I'll talk about that in another video. But this is sort of your upside from 1.75 down to zero. The historical average has been, call it 5%, okay? So if that's going to happen, we're going to go back to a historical average at some point. Interest rates go up, what happens to bonds? Bonds go down. As you're getting closer to retirement, more money's coming out of stocks. It's going into bonds. What's happening? You're taking more money. Essentially, this is like you're jumping out of the frying pan into the fire, okay? You're taking more money out of things that are growing, and you're putting into things that have some serious headwinds with this interest rate environment. So, I think that's the big elephant in the room. There are some other things, and this is another problem that I see that people have when they're using target date funds. Last point I want to make. If you look at your 401k, your current holdings that you have in there, you might have a growth fund, the S&P 500 fund, an international fund, and maybe a bond fund. And then you have this target date fund. So you've got four or five different funds in your 401k, okay? You've just taken this allocation that says, 80-20, which is going to adjust along the way, and you've sort of muddied it up with these other investments because it's throwing that allocation off. Said another way, if your portfolio should be 70-30 stocks to bonds, then have it 70-30. So either just own the target date fund, which I think has some risks, which we talked here, or the solution is to actually break it up, okay? Break it up into parts based on current conditions. So sort of create your own target date fund. Right now, I think it makes sense. For example, a 45-year-old, 80-20 might make sense. If we look at that in 5 years, 80-20 still might make sense based on the current conditions. So that's what I had on target date funds. I hope it made some sense. If you have any other additional questions about it, I'd be happy to answer them. Just send me an email. And here's to your success.